There's a number under the news this week that almost nobody said out loud. It isn't the 17 American dead. It isn't the 50% tariff on Canada. It isn't even the $100 barrel of oil we crossed this morning. The number is 2. For the first time in the modern history of seaborne energy, both of the world's oil doors, Hormuz and Bab al-Mandeb, are shut at the same time. Both at once. Let me show you what that actually means for your money. Here's the week in 60 seconds. 13 straight nights of American strikes have choked the Strait of Hormuz. 13. And while everyone watched the Gulf, Houthis declared a naval blockade of Saudi Arabia, turned back Saudi tankers, and struck again in the Red Sea this morning. That closes Bab al-Mandeb, the back door. Now, understand what that means. The Saudis spent 2 years rerouting 70% of their crude through the Red Sea precisely to escape Hormuz. Both doors just shut on the same hinge. Brent crossed $100 this morning, up 40% in the last 3 weeks. Gold is holding above 4,000, and LNG carriers have stopped transiting Hormuz entirely. Not slowed, stopped. And here's the part that makes this week different from every escalation you've watched since April. The same week the world lost both of its oil doors, Washington opened a second front against a friend. Section 338 of the Tariff Act of 1930, a statute that sat dormant for nearly a century, was revived on July 20th in 3 presidential proclamations. 50% tariffs on roughly $20 billion of Canadian goods. Wine, dairy, furniture, hockey gear. But listen to what was carved out. Energy, potash, critical minerals. Hold on to that carve-out. It's the whole story, and I'm coming back to it. Prime Minister Carney agreed to intensify talks, but said today that Canada is ready to respond if these take effect. And the clock now has a date, August 19th. Now, the consensus. Every desk on Bay Street and Wall Street will tell you the same thing. War premiums revert. And historically, that's true. But it's incomplete in the one way that costs you money. Here's why. The price of oil is no longer set by barrels in the ground. It's set by physical passage, by whether ships can move. The IEA says supply is still 9.4 million barrels a day, below pre-war levels. There is no cushion, which means every single incident produces a violent move because there's nothing to absorb it. And the American doctrine now in place. 1 Iranian targets struck for every ship attacked, removes the off-ramp mechanically. Every tanker in the Gulf is now an escalation trigger. And the off-ramp everyone was pricing? It's gone as of yesterday. Iran rejected the ceasefire deal that the Iraqi Prime Minister carried to Tehran. And the president's response was, Iran needs, quote, more of the same. There is no glide path on the table, only a wide band of volatility. And remember, Iran's anti-ship capability was not degraded over these 13 nights. It was demonstrated. So, put it together. 2 straits closed abroad. A 96-year-old statute weaponized at home. These are not 2 stories. They are 1 story. Geography itself is being repriced as risk. The efficient map, the one every supply chain, every portfolio, every business plan was optimized for over 30 years, is being dismantled in front of you. You're seeing in oil, in gold, in freight rates. That premium is simply the gap between the map you built for and the map that's arriving. So, what do serious operators do about it? Well, three things. First, recognize that capital is already rotating out of the AI story into hard assets and proven cash flow. Apple just retook the #1 market cap spot from Nvidia. Alphabet beat earnings with 82% cloud growth and still fell 5% because it raised AI spending towards $205 billion, and the market said, "We want payback now, not promise." Check your own concentration risk. Ask the question nobody asks. How many hostile gates do my inputs pass through? Chevron is reportedly building a Hormuz bypass, Iraqi fields, pipeline to the Mediterranean. That's the template. Buy the bypass before you need it. Third, and this one is for every Canadian watching, see the gift inside the insult. The tariff didn't touch energy, potash, or critical minerals. Washington just told Ottawa, in writing, where Canada's leverage lives. Now, and I've seen this movie from the inside. I served in Canada's Prime Minister's office during the 2008 financial crisis, and in December of 2008, the morning line was clear. Canadian taxpayers were not going to bail out GM and Chrysler for their management failures. The Prime Minister said so himself in the morning meeting. Then Washington called, and the message, stripped of the diplomatic language, was this: contribute Canada's share, or the auto pact goes out the window. And the plants come home to the States. Put simply, blackmail. That's what it was. And by December 20th, Canada announced $4 billion federal and Ontario together. A 108-degree turn in a matter of days. So when I look at this week's carve-out, I know exactly what I'm reading. It's the same message with better manners. Washington just told Ottawa which Canadian industries it considers leverage. And the window to act on that knowledge is always shorter than it looks. Ottawa is moving. 1 million barrels a day from Alberta to the Pacific. A $2 billion armored vehicle order built in Ontario. A pledge to double non-American exports within a decade. The question is whether Canadian operators move as fast as their government for once. So here's your checklist. Do's. Rebuild your budgets with triple-digit Brent as the working case and mid-90s as the floor, not the ceiling. And price the bypass now, while it's an option, not an emergency. In a non-exempt category, diversify the buyer, not just the product. Watch any reopened ceasefire channel, because Tehran said no yesterday, and the next signal moves this price $10 in either direction. Watch the $4 American pump price. That's when this becomes domestic politics. Watch gold above 4,000 while the Fed talks tighter. And watch August 19th, the day the Canada tariffs bite. The operators who get surprised next quarter are the ones treating this week as weather. It isn't weather. It's the climate changing. Two gates closed on the same hinge, and a dead statute woke up against a friend. And both were telling you the same thing. The map you optimized for is gone. Build it for the one that's arriving. If you want this every morning before the market does, the corridor brief is free. Link below. If you want the full dispatch, the paid tier is where we go deep every Friday. And if you're making real decisions on energy exposure, supply chain risk, or Canada-US positioning, private advisory access is open. Link is in the description. I'm Joseph Soares. I'll see you in the corridor.